If I borrow against my policy, does my family lose money? What happens to the death benefit and cash value in the event of having policy loans? This is question number 8 in our 10 direct answers to IBC questions series. And we're going to be exploring that. We're going to take a look at what actually happens when someone does have loans out against their policy, what's actually taking place, and what happens to that death benefit in those situations. It's a great question, and one, frankly, that I think we need to talk about. So what is cash value? Cash value is the net present value of the death benefit. So it's essentially your equity that you have in the policy at any given time, whether that's year 1, year 2, year 25, year 50. That cash value is going to be a representation of that death benefit at that particular point in time, the equity that a person has accumulated up until the point where the contract would endow at age 121, at least in the United States. So at age 121, what would happen is the cash value and the death benefit would be equal at the time of endowment. That is how the contract is structured, and that's what's going to take place over the course of that time frame. However, your cash value, if someone does take out a policy loan, that policy loan is using that cash value as your equity. It's using that as collateral for the loan. So in the event of somebody's passing, if there is an outstanding loan, it will reduce the death benefit. Now, early on in a contract, that may or may not have a dramatic impact. Just as if somebody's using a lot of loans, say late in life, that could have a dramatic impact on the net outcome or the proceeds of the death benefit. Now, the thing that's important to understand is, let's say, for example, you're in year 10 and you have, say, $50,000 of cash value available to you, and the total contract death benefit is $300,000. If you had all $50,000 out on loans, your net death benefit that would go to your heirs or your beneficiaries in that case would be $250,000. It's going to be, because you've exercised or taken a portion of that death benefit early through the option of the policy loan, it's going to reduce that overall death benefit. So it's not necessarily going to dramatically impact your heirs or your legacy in that particular situation by a huge amount. It's simply going to reduce by whatever you had out at that particular time. Now, the important thing to think about and consider is that because we're using dividend-paying whole life insurance policies and we're recommending that people apply the dividends to future paid-up additions, what happens is those policy contracts, they continue to grow. As a result of those dividends, as a result of that guaranteed cash value growth over time, they grow in death benefit. So even though you may start out in, say, year 2, year 1 with, say, $150,000 in death benefit, by the time you reach, especially if you're exercising the full paid up additions rider to its capacity over the course of the contract, you could be in a situation where that policy went from having a $150,000 death benefit to $750,000 as an example. Right? Every contract's different, so don't hold me to that, but it's important for the sake of example to understand that there is growth taking place year over year over year in those contracts on both the death benefit as well as the cash value. So a person theoretically, let's say at age 65, they do have $750,000 in death benefit, and they've chosen to use $350,000 of the cash value. Well, there's going to be roughly somewhere around $375,000 of a death benefit available if that amount of money was used up in the policy loan at that particular point in time. So that being stated, it's important to think about how you want to use loans. The loans themselves don't really destroy policies whatsoever. Mismanagement or misuse of them, that can be a problem. So that's why it's important to have a strategy going in, to have a plan. How is it going to be used? What is it going to be used for? And working through with an authorized practitioner is going to allow you to be able to help figure that out as you determine where and how you want to put that cash value to use through the course of policy loans. Some clients will even have a policy that they use just for death benefit, just for that explicit purpose, where they really don't do much with the cash value. Not saying a person has to do that, but those are ways in which somebody can ensure that they're structuring a banking system that allows them to use the contract to its fullest extent, yet still be able to pass on the amount of death benefit that they want to at that particular point in time. Again, if we don't know when we're going to die, so we don't know what that's going to look like. So we have to use a little bit of a balanced approach as we structure contracts, as we think about leaving a legacy. There's ways that we can put that together that allow you to leave what you want to leave to your family and still do the banking function without dramatically impacting one or the other. So hopefully that was helpful for you to understand this particular aspect of the infinite banking concept.